Okay, great. Well, thank you so much, everyone, for joining us. I'm Jenny Casson. I'm the president of the Crowdfunding Professional Association for this year. And Brian Pillay, who's our main speaker today, is actually going to be president next year. So we're definitely here to listen to the community about your biggest issues, concerns, excitement about the regulated investment crowdfunding industry, being able to invest using in regulated crowdfunding offerings and then have them go have an exit that's a really positive exit is awesome, is a great thing. So I'm really excited that Brian is going to be talking about that today. I just want to quickly mention that if you're not currently a member of Crowdfunding Professional Association, I hope you will consider joining us. It's very, very affordable to become a member. It's either $100 a year or $10 a month. And there are lots of really great benefits to being a member. One is that you get to participate in our committee meetings where we deal with all kinds of interesting topics. For example, we have a very active policy committee where we're working on trying to change the law and make it better for those of us in the industry. So hopefully you'll consider checking out membership. We also have an event coming up in October. It's our annual summit. It's always an amazing time. It's in Washington, D.C. And on the first day, we meet with regulators and legislators to share our views on the industry. And on the second day, we all get together and hear from amazing speakers and get opportunities to network and meet each other and do business development together. And one thing that I really want to work on this year is really growing the community of people who are passionate about this industry. So we're going to have some connection calls and networking calls before the conference, before the summit, so that we can get to know each other, plan ahead the things we want to talk about while we're at the summit with each other, and then also some follow-ups after the summit to make sure that we really, stay passionate about all the amazing things that happen at the summit. So, Rose, I don't know if it's easy for you to put a link in the chat to our membership link and also the link to come to the summit. Um, uh, oh, what happened? Oh, she's just went off she's not a panelist anymore. Or no, maybe she left. Okay. I could put the link in the chat, but I want to go ahead and turn it over to Brian Belay, who, as I said, he's the vice president this year, will be president next year. He is amazingly experienced and has tons of expertise in the area of regulated investment crowdfunding. And so I'm going to let him share his presentation. Thank you so much,
Great.
Brian.
And thank you, Jenny. For anyone who hasn't already met Jenny, she's been doing a ton for the organization, for the industry. She was one of the people there at the signing of the Jobs Act, right, in 2012. So we have lots to thank Jenny for, and just super happy to have had you serve as president, and big, big shoes for me to fill next year coming in. All right. So I'll get into the topic for today. What we're going to be talking about are realized gains. So essentially looking at some of the data around exits and failures to date in regulated investment crowdfunding. Now, when we use that term, what we mean is typically Regulation Crowdfunding, Reg CF, and Regulation A, Reg A. I'm going to share my screen, and the way we actually came up with this topic was, we've heard a lot, and I think there's a lot of talk in the industry about companies that are shutting down, unfortunately, right? Especially with the general macroeconomic environment over the past few years. There's been a lot of negative news. It's been kind of hard times for raising capital for small businesses. And so we've heard about a lot of the companies going out of business. Now, we haven't necessarily heard as much about some of the successes on the investor side. And while raising capital is great and important for the issuers, we really do want to also make sure that we are paying attention to the investor side of the marketplace, right? And making sure that that we are communicating that there are some successes out there. And so, what this presentation is going to be is a little bit of an introduction, kind of general education, just so we can bring everyone up to the same speed on the same page in terms of what we mean when we talk about investor returns. Like, how does an investor who's investing in a debt or an equity deal actually get some of their money back? We obviously can't talk about failures as a part of that. And then we will look at some of the very quick case studies, a few of the successes to date. And at the end, I'm more than happy to take any questions as well. So throughout this, feel free to use the Q&A feature in the bottom. Put any questions there. I will get to the end of this. We can do kind of a live Q&A session. And so I probably have about 30 minutes of slides, maybe a little bit more, and then we can jump into the Q&A. So what we're going to be talking about today, as I mentioned, is how investors in investment crowdfunding realize returns, what an exit is and why it's different in the private markets than, say, the public markets, what the J curve is in equity-based investing. We'll also look at some very quick cash flow patterns and differences when you're talking about a debt or a revenue share investment versus an equity, whether that's stock or kind of that safe convertible note investment. In addition, we'll be diving in and very deep. I hope everyone here loves data. So my role as CTO at KingsCrowd and through a lot of what I've done is we're looking at all of these online offerings every single week, every single day. And we get lots of feedback on both the exits, the failures, in terms of investment outcomes for investors for those thousands of offerings that have occurred. So we're going to be actually diving deep into the data. We'll be taking a look at that. Then we'll do some very quick, I call them case studies. It's more of just, we can talk through a couple different examples where I think it's really enlightening and illuminating to show the different range of outcomes in terms of when someone says, hey, I invest in this company and I made 1.5x, that's awesome. But there's a lot more to that story in terms of, did they make that 1.5x through a buyback? Was it through a merger where they got stock in the acquiring company? Was it via an IPO? There's kind of all these different mechanics and ways that that can happen. So we'll be going through some of that. In addition, we'll be talking about debt-based offerings, some of the success stories there, and then other considerations I think to plan for, especially some of the ones that I've just noticed are typically more of an afterthought when you start thinking about things like really kind of nuanced deal terms or taxes. We'll briefly touch on that. And then we'll get into it. So upfront, I just want to make sure we're putting this up there. Really, this is for educational, informational purposes only. So please, this is not investment, legal advice, or recommendation to buy or sell any security. All of these small businesses, all of these startups are highly risky. So whether it's through Regulation A, CF, or Regulation D or anything else, these are highly speculative. Usually your money is going to be illiquid and locked up for a long time. I think a lot of people on this already know that, which is why you're probably here, but we hope to share more of the lessons around that. So just keep all that in mind in terms of this is for educational and informational purposes only, and always conduct your own due diligence and consult with your qualified advisors before making investment decisions. All right. With that out of the way, real quick, just about me to give you an idea of some of my experience for what I'll be talking about today. So I've made over 230 investments in the private markets, most of that through the online private markets, Reg CF, Reg A, as well as Reg D. I looked at my own portfolio this morning. As of this morning, I've had 26 exits. So I typically call an exit anything better where I get at least like 1x or better of my money back, and 37 failures to date. Now, that might look scary at first where you're saying, hey, Brian, there's a lot more failures there than exits. But hopefully what I'll be showing you today will put a little bit more nuance and light around what that means and why that is not necessarily a bad thing, especially where we are today. I do have broad exposure to alternatives. So in addition to the online private markets, I've invested in crypto, peer-to-peer lending, which is more of the debt lending. I made my first Reg A investment. So this was kind of even pre some of that Reg A plus, Jobs Act going live. I did that in 2014 and got into crowdsourced real estate as well, and collectibles art, a whole bunch of things. So I hope that this at least shows the breadth of my experience in the investing domain so that when we talk about some of these examples today, you'll have an idea of where we are coming from. All right, let's get into it. So you can't talk about exits and returns without talking about failures. They are kind of two sides of the same coin. So I am going to be talking briefly about failures, but again, the focus of what I want to do today is putting more of that spotlight on some of these successes to date, especially in terms of successes from an investor's perspective. So when we talk about, a whole bunch of reasons why companies can go out of business, these are some of the ones that were cited by CB Insights, but you can see it's a whole bunch of different things from running out of cash to being outcompeted, poor product, you can see. A lot of it, though, does tend to, if you look at most of those, what's the root cause of that? A lot of it kind of goes back to the team, right? So when you start thinking about why companies are going out of business, yes, maybe they ran out of cash, but was there something else the founder, that entrepreneur could have done? Now, there are definitely things that happen that are outside of the control of that entrepreneur, of that founder. But, a lot of the times, this is why when investing, especially in kind of smaller business, early stage business, a lot of people will tell you, a lot of investors will tell you, team, the founder, the entrepreneur, right? Like that's often one of the most important things. Now we take a look at we're going to start with some historical returns of angel investing because I actually think this is a really good kind of proxy and has some lessons for setting the stage of what we're going to talk about in terms of investment crowdfunding. Reason for that, right, is when you're talking about angel investing, these are investors who are investing their own capital. So they're not venture capitalists investing other people's money or private equity. They're investing their own capital typically, and it's in small early stage businesses, small businesses. Usually a lot of personal connections, kind of personal networks. But there are some good lessons for us to learn through some of these studies. So, one of the things when we're talking about returns of what we might expect to see, if we're taking a look at historical returns for angel investing, this was a white paper report that was done in 2016 originally with a 2017 update by Robert Wiltbank. It looked at a whole bunch of investments, basically from I think the early 2000s through 2010, 12. So, there's a little bit of the time period effect in there. But what you can see is a chart here of the return multiple. So this is the investment return multiple versus the total percent of all of those angel investments. So you can see that about 70% of all of the investments return less than 1x of the capital to the investors. A normal, sane person might look at this and say, well, why would you ever invest in anything where 7 out of 10 of these investments are going to fail or return kind of less than 1x your capital? This is also a good lesson for investment crowdfunding investors, right? Of why diversification is really key, right? You have a higher probability that if you invest in a company that it's going to go out of business or return less capital than if you than in returning positive capital. Now, I will get to some data in a bit that actually shows so far the failure rate to investment crowdfunding is much lower than traditional venture capital, but this is something to keep in mind. The other thing that's interesting in this chart and that we're going to be talking about just to try and put context around where the industry is at today is you can see that there were fewer and fewer really big returns, right? So 1x through 5x, you had maybe a 1 in 5, there was 20%. And then those really big kind of home run returns, there was very, very few of those. Now, another chart from that same report showed that if you take a look at how long those different bigger returns took, the holding period for those was much longer. Now, I apologize. I know we're getting really into the data, but I promise this is going somewhere. So, what is this telling us, right? If you take a look at this, all of those failures tend to be happening in 3 to 4.5 year holding periods, right? Whereas the ones that are really big returns often take 10, sometimes 12 plus years to happen. This is crucial because what we've seen to date in investment crowdfunding are a lot more of those failures, right? But from that, what we could perhaps surmise or perhaps assume is that the companies that are going to go out of business, that are going to run into issues, whether it's running out of cash or regulatory issues, tends to happen in those first few years of investment. And to really realize some of those larger returns, when you're talking 5x, 10x, 20x plus, you're waiting for 8, 10, sometimes 12 or more years. So this is what's often referred to as the J curve in kind of early stage investing. We are going to be talking about debt as well, so I want to make sure I just put that out there. But in terms of equity investments, if you have your initial portfolio value over time, so time is on the x-axis, what you tend to see is a dip in those initial years because you get those failures that are happening sooner rather than later. So again, assume you invested kind of all your capital in, say, 10 companies in year one. Companies that are going to fail are going to happen in those first few years. Typically, there will still be some failures later on, right? But a lot of them are going to go out of business sooner than later. So those larger exits that will end up moving the needle on your portfolio aren't going to happen until that 5 to 7 year plus, sometimes 10-year plus for bigger returns. So keep this in mind just to put in context when we're talking about all of the failures and some of the successes that we have seen to date in investment crowdfunding. I think this is a really important thing to remember. So, I could say with basically so many of the deals and the deal flow launching, industry kind of really took off in 2020, 2021. That was kind of year zero for our industry of kind of the median deal, if you think of it that way. So we're really kind of just in the first, call it 4 or 5 years of this curve right now in terms of the deals, which could be one of the reasons why we may not hear some of these huge successes, to date. But as I will show, there still have been some great successes that we will share. All right. I'm just going to check the chat real quick. All right, great. So thank you everyone again for joining us. Feel free to use that Q&A session. I will get to those at the end. So let's talk about, to get everyone on the same page, just right before we jumped into data, what we're talking about when we talk about exits for equity-based investments. Now, I know there is a great quote from David Ducini, founder, Silicon Prairie, CEO of Silicon Prairie Portal Exchange. He basically says an investment without an exit was a donation. So as an investor, you typically are looking for some return on your capital when you are investing in these deals. Now, what are the different types of exits that equity-based investors may be able to expect? An analogy, or one way to think about this, is let's say you're a car, you're going on a road trip, right? So the car here in this analogy is the company. Along the way, you're going to need fuel. And the fuel is that capital that's being poured into your company to be able to pay for operational expenses, R&D, everything else. Now, that capital can come from outside capital investors. And sometimes along the way, that could be in the venture capital model, your seed, your Series A, et cetera. That capital also could come from other sources for, financings from the bank, could come from capital that the business is actually throwing off if you're profitable and reinvesting in the business. Now, that is kind of the fuel that is helping this company, this car, to go along this journey. Now, along the way, there are kind of different off ramps and different exits, if you will, which are these exit opportunities for the founding team and for investors. Typically, earlier on, they may have some early exit opportunities by merger and acquisitions. These tend to be smaller deals, but sometimes you can have, the huge WhatsApp or other acquisitions, Instagram, where a company gets acquired for huge multiples. In addition, there can be buybacks. So this also can tend to happen more early on. I'll be talking about a few successful repurchases and buybacks within the investment crowdfunding industry so far. But essentially, that is when the company, so the founders or the company itself, is buying investors back, saying, "Hey, if you guys want to get out, we'll reimburse you or give you a return on your money, and in exchange, we now have your equity that's going back into the company." As you get further along, there tend to be opportunities for secondary sales or tender offers. Now, in the investment crowdfunding world today, this is still very nascent. So there are some secondary trading platforms out there. However, the volume, the liquidity tends to be pretty low for these today. But as the industry continues to mature, we can expect that perhaps that activity may increase. And then for more traditional angel investments, right, these could be secondary sales, tender offers. For example, we hear about tender offers all the time for SpaceX or other big companies like that, where they want to give some liquidity to their employees for an appreciated stock to be able to allow them to trade that out, which brings new investors in. But for those insiders who are cashing out, it allows them to take a little bit of their money off the table. Now, as you get further on this journey in the life cycle of a company, you may be looking at much larger mergers and acquisitions. These are, kind of strategic acquisitions, could be much larger acquisitions, and then typically those could end up being larger in scale and magnitude in terms of returns for investors, leading kind of to the penultimate, everyone wants to talk about and everyone wants to get as an investor, it's the IPO or the direct listing. So this is when the company that no matter where you invested along the spectrum, right, it's now listing those shares on a public exchange where those shares become liquid and can be traded. Now, in addition to the good outcomes, there are bad outcomes. And I think some of these bad outcomes I want to point out is not just that this company kind of runs out of fuel or runs out of cash, but there are some other bad outcomes that investors should be expecting that they will see. If you invest in enough deals, you are going to run into this. So an acqui-hire or an asset sale, a lot of times this is when a company is being bought for their talent and IP. Maybe the business model isn't working. They're trying to look for kind of a graceful way to exit, to get out. Typically, what happens in these, unfortunately, is that minimal, if any, investors will get returns because a lot of the capital it's either an all-stock deal that's kind of going to the team that's being acqui-hired, or perhaps, they're using some of that asset sale to pay off debt and those debtors first. So typically, very little, if any, returns to investors. In addition, there's what's called kind of a zombie company, which could be a company that's basically cash flow positive, that they're still around, that they're operating, but there's no growth. So they aren't growing, they aren't able to throw off dividends, distributions, they aren't able to attract new capital to be able to grow. So what happens for investors is your capital's tied up. There's no secondary market to be able to sell that, and you kind of just can't do anything with it. Then dilution. Dilution is a really important thing. Not going to go into it on detail. We have some good resources. Feel free to do some reading online. But basically, dilution is when more capital is coming in, but especially if it's at kind of a down round, which is lower valuation or even a flat round, it means everyone's piece of the pie is shrinking. So more capital is coming in, but you still have your same number of shares, and that's diluting your ownership because the pie is kind of growing bigger now, and the company value, unfortunately, isn't growing. In that case, that means if there is an exit someday, you're going to have a smaller percentage of that exit as an investor. Then there's the outright failure. So, bankruptcy, dissolutions, this is usually a total loss for investors. When we talk about debt and revenue share, I want to just help everyone to kind of understand the quick differences between those, and then we can kind of talk about a few of the nuances. So debt and rev share deals typically return more steady capital, typically faster than equity, but usually it has a capped upside, right? So for debt deals, for example, you're looking at fixed distributions. So it's either done monthly or quarterly or semi-annually or annually. For example, you might see a 10% interest rate paid quarterly over a 3-year term, something like that. So at the end of those 3 years, if we're just assuming simple interest, each investor would get $1.30 back for each $1 invested. A revenue share, by contrast, is similar in that you get these kind of fixed by time payments. However, the distributions themselves will vary to basically scale up or down based on the revenue of that company. And there are some other variations of this, like profit shares. But for example, a simple revenue share agreement could be like a 10% revenue share, semi-annual, up to a 1.2x payback. So it's saying it's going to be a little bit of variable rate, which can be good for the business to give them more flexibility for those payments. But once you've received 1.2x or 20% return your money as an investor, that's your return. Now, this sounds fine, right? And you might look at these two kind of side by side and say, well, with revenue share, I get $1.20 back per $1 invested. With debt, these are just numbers. There's higher payback multiples than that and everything else. But the one other component to this that investors need to be aware of is that there can be higher annualized returns with revenue shares that pay back sooner than are expected. So, for example, with this situation, if that 10% revenue share, the 1.2x payback multiple, was done over a 3-year payback period, that's a 6.27% return versus a 1-year payback period could be a 20% return, which could actually be faster, right? And a higher rate of return than even the debt example over a 3-year term. So that's just an important concept. I'm not going to spend a lot of time on this. I did put this slide in here for reference, but basically one way to compare returns across different types of deals, whether it's equity and debt and revenue share and over different time periods, that's where it becomes important, is the concept of something like the internal rate of return, which is basically just your annualized rate of return for comparing different investment opportunities. This is the equation. Again, not going to spend a lot of time on this, but good thing to think about as an investor. It's not just that number of I got 1.2x, I got 1.5x, but like what time frame did you get that return in? Okay, now another thing that I hear this a lot of times as well is just like, oh well, yes, the debt rev share deals have a capped upside. Maybe it's a lower interest rate, but they're lower risk. Yes, but I think that there's a perceived lower risk with a lot of debt and revenue share deals. Now, they can be, especially if they're later stage, they have asset-backed businesses, especially if there's things like real estate and some of these other offerings. There are assets backing that, which means if stuff does go south, even investors may get some of that money back. They could have existing cash flows, inventory, collateral. So there is some reduced risk, especially kind of compared to equity. However, it is not zero risk, right? Nothing is risk-free. These are still small businesses. So investors should definitely keep in mind that defaults will happen. You need to kind of build that into your model when you're thinking as an investor, am I getting a good enough interest rate to compensate me for the risk that I'm taking here? You should be thinking about all of those things alongside each other. Okay, with all that set up, I want to jump into the Reg CF and Reg A Plus exit failure data to date. We're going to take a look at kind of broad exits and failures, and then we'll also be diving down into some specific successes that we want to highlight because we did want to, again, spend more time today on highlighting some of the positives, despite potentially being in that part of the lull of the J curve where we are as an industry today. So from King's Crowd data, we collect basically exits, failures, a whole bunch of different repurchases, repayments across all the companies that have raised online. So we source this from the companies themselves, sometimes from working with the funding platforms, from investors. There are definitely some that are going to be missing here, right? Because there's been 9,000 plus offerings to date, since 2016. So it's going to be very hard to track every single one of those every single day. But we do our best to basically take them, we categorize them into some of the different categories you see here. So if the business just shuts down, if it's a repurchase or a buyback or repayment, a merger and acquisition, an IPO, bankruptcy, asset sale. So we categorize them into kind of those higher buckets. And as you can see from this trend, there was definitely an uptick in failures. So the big red bar here, which is the biggest each year, are the businesses that are shutting down. You can also see in 2023, there were a lot more bankruptcies. Now, if you go back and just think of your mind where the economy was, kind of where the public markets were in 2023, this makes sense. We kind of had the big boom in the public markets, if you remember, in 2021, and then the pullback over the ensuing, the next 2 years. So far, 2025, again, this is only data through, it's actually through August, not through the first half. But you can see there's been definitely fewer bankruptcies if you're to extrapolate this throughout the end of the year. And also failures kind of on par with 2024, maybe a little bit under actually, but still below those levels that we were seeing in 2022, 2023. So good news for small businesses, for investors. Now, on the other side of things, we haven't necessarily been seeing lots of more IPOs either. So there were a lot of IPOs kind of happening in the 21, 22 timeframe, 2020, 2021 timeframe. But what we are going to hopefully see as we move forward is more of these companies will be maturing. We do see and we track at King's Crowd a lot of the companies that are getting markups based on ensuing basically follow-on funding rounds at higher valuations, who are growing their revenues year over year, who are hiring more employees. So we know there's a lot of good growth happening in a lot of these companies. We just haven't gotten to that point of a quote exit to date yet. Just for quick numbers, I think I pulled the numbers right before this, but there was around 650 exits that we're tracking. And if I pull up the numbers, around that was 450 were about shut down businesses, about 100 were mergers and acquisitions. We've had 38 IPOs so far to date from companies that have raised at least one Reg CF or one Reg A plus round online. So lots of potential exits that are occurring out there. Now, just because something had a merger and acquisition, had an IPO, also does not mean it was necessarily a good outcome for investors. We'll be talking about some of those shortly. But this is in terms of the categories of potential exits for investors, this is kind of the distribution that we're looking at today. Now, again, the other side of that coin, right, if you're thinking about successes, is failure rates. And previously, I kind of showed you that if you're talking about angel investing, venture capital investing, you might be seeing 60% failure rates, 70% failure rates, sometimes higher, right? The failure rates to date in the regulation and regulated investment crowdfunding industry have been very low relative to traditional angel and VC. So this was an analysis we did towards the end of 2024 at King's Crowd. We looked at the failure rates by bucket. So we grouped buckets based on if they were pre-revenue, if they had up to 500,000 in revenue, 500 to a million, million to five, and then on and on. We can see is not completely unexpected. It's basically a declining trend of failure rate with increasing revenue. So as companies tend to be more mature, as they have more revenue on the books, they do tend to be slightly lower risk from this perspective, right? Which makes sense. A lot of pre-revenue companies, these are companies they don't know, they might not have launched a product yet. They don't know if they're going to find success in the marketplace, and so they're much higher risk. Now, that being said, even looking at that highest risk bucket of 7.1%, that's a very low failure rate. Now, again, as I mentioned, there are probably some failures, there are definitely some failures missing from the data set. But even if we double that and said, 15% of pre-revenue companies have failed, 15% is such a small failure number compared to the 60 to 80%, numbers that are cited for VC for that type of thing. So overall, the industry has been successful from that perspective in terms of being able to provide capital to companies that at least have continued to operate. This does not mean that the other 93% of these companies have been great successes for investors, but they at least haven't been shutting down, closing their doors. This is the numbers again. I'll gloss over this, but again, if depending on what seed of traditional venture capital that you're comparing it with, the failure to exit could be extremely high, right? This is all small business data. This was taken from a Medium post, I believe, but you can see the overall average for failure is around 80% for companies to exit. So take that versus the 15% looks pretty good. Just one other chart to talk about before we jump into some of the case studies. This was an analysis that I did earlier this year, end of last year, around interest rates, debt, and payback multiples by revenue bucket, kind of trying to say, based on the failure rates for those deals, what is the interest rate or what is that payback multiple that investors would need to demand to be able to at least get their money back, like break even versus, risk-free rate. So based on this, again, pre-revenue, you need to be demanding the highest interest rate based on this analysis. This is backwards looking data. So obviously none of this is a guarantee of anything in the future, but you can see that for pre-revenue, if you made about 11% interest on your deals or 1.5x payback multiple from your rev share, then you were essentially breaking even with the expected failure rate. In addition, you can kind of follow this down, but it shows that most interest rates should fall in that 10 to 11% bucket, at least when you're looking at debt deals. And when you take a look at some of the debt deal interest rates that were offered, this is a chart through, again, the end of 2024. You can see that most of the interest rates are actually pretty fairly valued based on that analysis, where a lot of them do fall between that 10 to 14%. All right, now let's get into some case studies. So we reached out to a bunch of the funding platforms. We reached out to investors. We reached out to a whole bunch of different people to just get some examples from debt deals, from equity deals of some successes to date that we could share. So a lot of these investments, all these investments shown here are debt rev share deals. You can see they're across a couple different platforms. You can see some of them are multiple kind of series offerings. So GeoGreens and GeoGreens 2, Aurora Market 2. But all of these paid off successfully, paid in full. Many of them paid in full in less than a year. So if you look at kind of the time periods here, June 24 to Jan 2025, that type of thing. So what we are looking at are the interest rates of the original offering, kind of ranging from that 5 to 10%. When it was paid in full, the ROI, and then the annualized ROI, which is kind of harkening back to that IRR, the internal rate of return number. So taking a look at this, you can see that actually most of these deals paid between a 9 to 10% return rate. Now, these were all debt offerings, but again, showing that there have been these plus many others that have successfully paid back investors on the debt side. I also want to give a shout out to Angel Studios and Fred Pena. So they've done a bunch of different offerings that have been very successful in terms of being able to raise the capital, but also extremely successful for the investors who invested in those. So if you look at a few of these different films, Angel Studios Inc., The Shift, His Only Son films, these were all revenue participation, promissory notes, usually around 20%. They returned in 42 days, 59 days, 77 days. There's some other examples and successes like this, but if you do the ROI calculation on that as an investor, that was a very good use of those investors' money to get that amount of returns within that amount of time. So more great example successes there. If we talk about some of the different equity-based successes, so I'm going to break these into three categories. We have I'll talk about some repurchases, buybacks, which again, those tend to be earlier on that journey. If you think of that diagram again of the car going along this trip, we'll talk about some acquisitions and mergers. We'll also talk about some IPOs and some companies have gone public. So a couple successes, and again, this is just a small picking, but just to show that there are a lot of successes out there and have been. So Trust and Will, this is back in I think 2020, 2021. They raised on a safe originally and actually did a repurchase in less than 11 months of a 1.5x for all the safe investors. So 45% IRR when you calculate it out. Pretty good return, right? Compared to what you could get in the stock market of call it 6% or 8% or 10%, whatever you want to do. So pretty good return. Now I am going to I'll put an asterisk on that. One of the risks, one of the things I want to talk about are repurchases, right? And repurchase rights. This looks like a fantastic return on paper. It absolutely was. But that company continues to do extremely well. So the question is, if those investors had not been bought out, if they had still held the equity, would they actually be up a lot more than that today? That's one of the things, again, that we'll be talking about in the nuance section of things investors need to keep in mind. In addition, Ludus is another company that was a safe. Forgot to put the number in here, but it was a 3x safe repurchase in 3 years. So again, very good return, a little bit longer time frame, but you can see did more than 2x the other one. Another company, Generation Genius, this is one where the founder had actually reached out to us to tell us about this. They actually offered a 4.1x return through voluntary stock buyback to all their crowdfund investors. And actually, first round investors ended up cashing out about a 10x return. So some of those people were able to hold on to their stock, but to be able to cash out a 4x to 10x return was pretty good. In addition, Tolino Venture Labs, this is another one that was a safe repurchase. So again, a lot of these are safe repurchases. I'll be talking about repurchase rights a little bit more in a little bit, but good returns for investors, right? And typically, the way that I've seen these get paid out from a couple examples, it's usually they'll send you a check. They'll, as an investor, ask you for your Venmo account or whatever it is that they choose how to distribute those funds, is typically how they are paid out in cash. All right, let's move on to some acquisitions and mergers. Now, I do want to call out that a lot of times, for good reason, right? Founders may want to save face if the company's not going as well as it could, they need to shut down, they will get acquired by another company. Those tend to be acqui-hires, tend to be asset sales where investors aren't getting anything for that deal. Now, it can be fine for the employees and sometimes even for the founders, but it's typically not a good outcome for investors. So the ones we want to focus on were just a few handpicked examples of successes on the investor side. So some other ones that we can take a look at. So SolidTrack is a company where investors was acquired, I believe, and actually investors reportedly received 2 to 3x. Oncolize, this is one that has a little bit of a nuance to it. I'll talk about briefly. So this is where a lot of the investors were received when they were acquired for their original value of their investment plus 10% interest. So perhaps not a super great return, but they're getting some money back, not a bad deal. The one nuance to this, and this is again one of those dynamics where there's just so many different ways that a company quote exits. It's not just a simple acquisition or a merger. So in this case, non-accredited investors had to cash out. They basically were told they weren't able to continue holding the stock because they weren't accredited, and the shares of the acquiring company would have to be either issued or held under Reg D, something along those lines. So in this case, the accredited investors were given the option where they could choose to hold the stock in the acquiring company or they could cash out. Now, again, there's a whole bunch of examples we could go into similar to this, but I think this is just highlighting another kind of nuance in terms of when a company gets acquired, there are also a bunch of different meanings of what that could end up meaning in terms of the investor. So they could get paid out in cash, right? That could be one outcome. You could get stock in the acquiring company, which I have several of those where the company gets acquired. I now own company in the acquiring company, but I can't yet sell that, right? So I haven't necessarily gotten an exit, even though my stock has been converted into a new company. Sometimes you can sell a little bit and get paid out in cash and hold some of the stock. So there's kind of all these different spectrum of outcomes just for a acquisition merger. In addition, Gatsby is another example. So this was a company that was acquired by eToro for 50 million in cash and common stock. It's about a 1.3x return for investors. Now, there haven't necessarily been any massive acquisitions or mergers that we could find for investors to date. So a lot of them have been these kind of smaller, 1x, 3x, 5x, still great returns for investors because, again, of that time period effect. What we would expect, right, is as the industry continues to mature, as we get further along that J curve line, is if companies are going to be successful in a much bigger way, getting acquired for hundreds of millions or more, and or going public, those are going to tend to take longer in time to occur. And so that could be one reason we haven't seen some of that to date. All right, let's talk about the big one, IPOs. And we kind of lumped IPOs together as public listings, but it could be uplistings, going public through Reg A, could be direct listings, SPACs. Actually, Boxable just announced a SPAC. I don't know if everyone has heard about that. That could be a good one to list that wasn't even included here. So Boxable, their first round, actually, I believe, was at a 20 or a $30 million valuation. So extremely low. The SPAC deal is for $3.5 billion. Now, there's going to be a lot of dilution in there. So the outcome for investors of what that means in the first round is unknown, but a lot of their later rounds were in that $3 billion to $3.5 billion range. So again, are investors going to make money at the IPO or kind of just get their money out? It's still to be seen. And I think a lot of that brings up a good point of what happens after the IPO can be a big driver of potential returns, right? So if you decide to sell day one, if you're able to sell day one, which is something we'll talk about, that could be, you're locking in your gains or your losses at that time. But sometimes holding on for longer could also be a strategy if you believe in the long-term potential of that company. So one example of this is a company I had actually invested in, Atlas Motor Vehicles. They changed their ticker to NXU. At the earliest round, they were a $2.9 million valuation. I think it was 29 cents per share. They IPO'd at around $29 per share, if I recall. And I think the stock traded as high as $290 per share. The issue for a lot of investors, especially Reg CF, and again, this is one of the nuances. Reg A investors, I think, were actually liquid in the first week. They had access to their shares. They didn't register the Reg CF shares. And so Reg CF investors weren't technically locked up from the perspective of a traditional kind of lockup period post IPO, but they just couldn't trade their shares yet. So a lot of investors didn't get access to their shares until weeks later. And by that time, the price had kind of come back. So for a lot of investors, if they sold at the time, several weeks later, still a very good return if you were in that very first round of, 2.9 million. Now, when you invest in a later round, if you're already investing in a $1 billion valuation, fortunately, a lot of those investors probably lost money. So that's where the valuation that you're investing at is a very important thing for investors to be considering. It's not just, did the company IPO? That means everyone made money. It really matters about that valuation you got in at. In addition, so Monogram, this is another company, did 5 online funding rounds through, I think, Reg CF and Reg A Plus. Their first one was at a 21 million valuation. They IPO'd. They had some rough times in terms of the public markets after IPO. However, they were recently acquired for 177 million in July of 2025. So that shows, some of those investors who potentially had maybe invested early on, maybe held on and kind of were down a little bit in the stock, eventually, have seen a stock price appreciation in that one. And again, another example is Newsmax. This is the big one from this year that I think a lot of people are probably familiar with. They did a $75 million Reg A Plus, $10 a share, uplisted on the NASDAQ, New York Stock Exchange. At one point, I think the stock was trading around 200. It's maybe back to 12 bucks a share as of recently, but for investors, who invested, potentially a good success story there. Now, IPOs to date, the other thing I would just say is a lot of these IPOs, right, have come from a place that's maybe a little bit different than some of the big blockbuster name IPOs that you might think about, right? So when a company, for example, like Uber or Facebook or some of these companies that you think about, oh, if you had invested in their first round, invested in their IPO, you would have made all this money. That's not always the case. There's not a playbook where it says you go from point A to point B and then that's where it ends up. So a lot of these companies are using going public as another way to raise additional capital to continue to grow their business, right? It's not just always a liquidity event for the earlier investors. And I think that as the industry again continues to mature, we're going to see lots more examples of IPOs. And then my hope for the industry and for investors is that we do see some really big names, some successes that started as a investment crowdfunding company, were funded all the way through, and finally made it big to become, that household name, which would be a great win for investors, a great win for the companies. All right, it is, I know I'm 40 minutes in here, so I'm going to go a little bit quick. I do want to get to a few questions. Again, if anyone has questions, please drop them into the chat. So a couple afterthoughts, other investor considerations. So taxes, I think this is something many investors today are not thinking about taxes. This is not tax advice, but you need to do some research on this. So think about it, look into potential benefits for tax deferred gains, or even sometimes you can get tax exempt gains under qualified small business stocks. So section 1202, 1244, 1045. Look it up, consult with your tax advisor, but just think about it ahead of time. Other deal terms. So, sometimes there's differences around just thinking about simple versus compound interest. You got to read the nuances of what you're actually getting. Liquidation preferences, if you're investing in preferred stock, or even more, if you're investing in common stock, you should be looking at what liquidation preferences are outstanding from prior round investors, if any, for preferred, because those can impact your returns if and when there's an exit. Repurchase rights, this is one I mentioned, typically came with safes. We haven't seen it as much on some of the deals, though there are some platforms that have some of them baked in. Essentially, though, what this means, going back to my example, Trust and Will, great company, 1.5x return in 11 months. No one would, shrug that off. That's a great return, 45% IRR. However, if that company had continued to do extremely well, those investors may be much better off today. So typically, you can think of repurchase rights as the company is only going to want to repurchase those shares if they are doing well. And so sometimes, unfortunately, it can be used with misaligned incentives to buy out earlier investors because a VC wants to clean up the cap table and get rid of the crowdfunding investors. And then that company goes on to great success. So still good because those investors are going to get a return on their money. But sometimes it's getting them out. It's like capping an upside. It's an artificial cap on the upside when those companies would have otherwise been doing well. But just something to look out for, not necessarily a reason to say yes or no. Undisclosed valuations, just mentioning this. we see some deals out there. We look at all the deals in King's Crowd. Sometimes they don't disclose the valuation and there's a share price. Share price, just so everyone knows, is completely arbitrary, right? You can say you have 1,000 shares or you have 10 million shares and your share price is going to change based on how many shares you have outstanding and issued. So valuations are what really matters. That's kind of what you're investing in. That's the value of the company. That is what matters in terms of the future potential appreciation of your investment. So make sure you're thinking about that as an investor. In addition, access to shares during IPO. This is something that I think we're going to see more as the industry continues to mature. But how do you actually get access to your shares as an investor? A lot of times, after you make the investment on a funding platform or a funding portal, it's going to go to a transfer agent. Now, do you even know where that transfer agent, that custodian, whoever is before the IPO? If not, you might have to scramble to try and figure it out after the fact. You got to get your paperwork in, figure out where your shares are. You then have to transfer those shares to your brokerage account to be able to sell them. So sometimes that's where this can take weeks in time as a process to be able to get access to your shares to then do something with it. So it's just something to think about if you hear that one of your companies is going to be going public or has listed or is thinking about it. Start potentially thinking about, do I know where those shares are actually held? Because that has been one of the big stumbling blocks, one of the stumbling points I have seen a lot. And dilution. So we've already mentioned this, but if a company is supposedly raising lots and lots of money, but not really growing, that's really just diluting existing investors. So this is just another risk that investors might not think about. They might think, hey, I invested in this and now they're going public at this. That's great. But did they actually grow along the way? Or did they take in a lot of capital to get there? All right. I am going to stop there because I know we're coming up on time. I want to make sure I save time for questions. Thank you, everyone, for coming in today. So let's see. Do we have questions? Jenny, any questions from you in terms of other things? Oh,
There's a question from Brian Christie in the chat.
okay. Sorry, I'm going through all the chats. So
The very end.
yes, so for Oncolize, my understanding was because of the way that the acquiring company was going to be giving shares, that those shares could only be given to accredited investors. So they required non-accredited investors to cash out, whereas I think accredited investors were given the essentially given the option of whether to hold or not. So your point was, if so, perhaps it should be listed as a generic risk factor for investors. Yep. All right. Just going through other ones here. Any other questions? I'm curious, just in the chat, but has anyone else here, any other stories, good, bad, or ugly? Feel free to share them. And what we really want to do at the CfPA is just bring more transparency to this, right? Like we know that the kind of Reg CF went live in 2016. We're really just kind of getting to the point where, again, a lot of those deals kind of started getting more popular and we saw a lot more issuer activity around 2020 and 2021. The industry is just getting to the point now where it's maturing, where we are going to be seeing more of these, I'll call them, kind of kinks in the plumbing of the industry and what things don't work well, like the transfer agent thing. Or I've had ones where I had a company choose a transfer agent that was probably a great transfer agent for your traditional institutional investor, but they had an extremely high fee to transfer your shares out. So if you're a crowdfunding investor who invested $100 or $200, it made no sense for you to pay the $80 fee or whatever it was to get your shares out. So that is something that, again, I think as issuers, if there are founders, entrepreneurs, issuers out there, you should also be thinking about these things, especially if you're thinking about, how do we provide successful, good experiences for our investors to make sure we're taking care of them. It sounds like kind of an afterthought a lot of the time, but I think a lot of these are really important details that we're going to be thinking more about. Another question. So do we know the failure rate of Reg D compared to Reg CFA? Paul Lovejoy. So the failure rates that I was showing from Crunchbase is more akin to what you would expect in Reg D. So that's typically the numbers I've seen cited in a lot of the angel reports tend to be around 60%, 70% fail, where fail is returning less than 1x of your capital. And granted, we haven't seen kind of the full life cycle of Reg CFA yet because the industry is, still maturing. But that failure rate, as I showed, was around 7%, 8% today. Even if we assume we don't know about doubling that, if we say, half of them haven't even occurred yet or that we don't know about. It's still a 15 or call it even a 20% failure rate. It's a much lower failure rate than traditional VC and angel. So this seems like Reg CF and Reg A are working as a source of capital for helping these companies to continue to operate. Now, again, the outcome for investors is still to be determined and to be seen, but it seems kind of anecdotally, and there's probably other reasons for that, right? If venture-backed companies are trying to scale to IPO, they're probably getting pushed for hypergrowth and growing at all costs, not necessarily trying to be profitable, trying to run, cash flow positive. So there's other things that may push those businesses to the brink of going out of business much sooner than a CF or an A company might. Another question from Mike Van was asking to elaborate on the safe buyback. Yeah, so essentially what happened. Now, typically the way this is written in is, and I haven't seen this in a lot of the most recent deal terms and on a lot of the platforms, but it typically will be a clause. It's called a redemptive clause or repurchase rights, where it gives the company the option to buy back shares at either the fair market value or original investment amount plus some amount. So it might be, in this case, it was 1.5x. So in this case, what they did is they had an outside firm do a fair market value assessment and said, okay, fair market value is this. We said we were going to pay the minimum of either the fair market value or the 1.5x return. We're going to pay the 1.5x return. I won't get into a lot of details. It was done during COVID. It was like everyone's valuations were down. So I think a lot of the investors felt like they knew the company was doing extremely well and was maybe getting encouraged to do this from another investor, but that's all speculation. So in the end, though, that's where this little bit of misalignment of incentives can come in, where, if a company has that as an option in the subscription agreement that investors sign, when push comes to shove, if they're trying to get a new investment from a VC and the VC says you need to buy out all of the earlier investors, they may end up doing that. So I tend to shy away from those now when I can, just because, again, it's kind of artificially limiting that upside on those investments. But again, I don't see that as often in a lot of these deals. All right. Other investors, other questions. Thoughts on emerging ATS options, aka secondary markets? Yeah, so the secondary markets is something that a bunch of the platforms, I believe, if I'm not mistaken, even David yourself and Silicon Prairie may have an ATS in the works, and then there's some other ones that are out there. There have been some in the past as well. From my experience, a lot of them we still haven't seen a lot of liquidity yet. So a lot of the times liquidity, what do I mean when I say that, right? There's just not enough buy and sell, or one side is kind of overpressured where there's many more buyers than sellers, or vice versa, just because it's so early, right? Like this isn't the public markets where anyone can, sign in with their brokerage account from many different places, and there's millions of buyers and sellers that kind of come to a good price. So what ends up happening is it's either that spread of between the buy, the bid, and the ask is really wide, that there's anyone who does kind of take the bid or the ask is usually either being overpaying or getting a really good deal. And so I'm still seeing a lot of that, where we've seen some companies and some of the platforms themselves do some of these listings on the secondary platforms. I think it's good, I guess, from the perspective that if someone really needs their money as an investor, it's at least an option to give you liquidity. Personally, knowing and this is just Brian not speaking on behalf of KingCrowd, not on behalf of the Crowdfunding Professional Association, the biggest obstacle I feel to most investors doing well is we are our own worst enemies in terms of investor psychology. And you're going to want to sell at the worst possible time or buy when prices are at their all-time highs. One of the benefits I see in the private markets and in companies like this is that your money's locked up and you don't have a choice. You're holding on through the goods and the downs and the swings and the volatility. And that's how some of these people can say, hey, I made a huge return. I got 100x. Yeah, like, would you have made that if you were able to sell your securities? So I think it's good still in the long run, but I think that they still have a ways to go to mature. All right. With that diatribe, I will end things there. Thank you very much, everyone, for joining us, though. Again, at the Crowdfunding Professional Association, we really want to help educate and advocate and just bring more awareness to the investment crowdfunding industry. So hopefully everyone found this helpful, insightful. We will provide the slides afterwards. We'll send those out over email along with a recording. Thank you again for joining us, and hope you will all join us for the summit. If you didn't already, please make sure you head over check out the Investment Crowdfunding Summit this coming up this fall in Washington, D.C. Join us in person. I was there last year. Just an amazing, amazing group of people. You won't believe the speakers. You won't believe just the different people that we have coming for the panels, whether you're a founder, whether you're a investor, whether you are a platform or a service provider. We have amazing, amazing resources and people that show up to that. So thank you very much, everyone. And we will see you all back here next time.